Strategy opens door to selling billions of Bitcoin under new capital plan. Here's what. The leverage shift starts now. Here is the signal that separates noise from actionable change. We will map trigger, incentive shift, and downstream impact before the close. This isn't speculation. This is institutional-grade infrastructure, and it changes how we think about Bitcoin's liquidity ceiling. Let's start with the mechanics. For years, the constraint wasn't whether institutions wanted to sell Bitcoin, it was how. Dump a few billion onto an exchange and you crater the price. Sell slowly over months and you lose time value. But this new strategy does something different. It lets holders unlock liquidity without hitting the spot market. Think of it like a repo market for Bitcoin. You're not selling your Bitcoin. You're borrowing against it. The difference is enormous. Why does this matter? Because it changes the cost of capital for every major Bitcoin holder on the planet. If you're a corporation, a sovereign wealth fund, or a large trader sitting on billions in Bitcoin, you've always faced a choice: hold forever, or sell and pay massive slippage. Now you can borrow against it at rates that might be lower than your cost of equity. That's not theoretical. That's a capital efficiency play that every CFO in the institutional space is running numbers on right now. Here's the second implication, the one most people miss. This is deflationary for Bitcoin supply dynamics. If major holders can access liquidity without selling, spot selling pressure drops. That sounds bullish. And in the short term it is. But here's the contrarian angle. It also means less Bitcoin actually changes hands. The network becomes less dynamic. Turnover shrinks. And in a market built on perceived scarcity, lower turnover can feel like scarcity, which usually bids price up. But it also means whales have less reason to exit positions, which concentrates holdings even more. Now let's talk about who this actually impacts. First, institutional investors. If you're a pension fund or insurance company with crypto allocation, you just got a new tool to optimize returns. You can sit on your Bitcoin and borrow against it at 3 to 5% instead of selling and paying capital gains tax plus slippage. That's real money saved. Millions per billion-dollar position. Second, exchanges. This strategy bypasses traditional spot markets. That means transaction volume on centralized exchanges doesn't necessarily rise, it might even compress. Smaller exchanges lose out. Derivative platforms and lending protocols win. That's a structural shift in market microstructure. Third, regulators. They're watching. If major market participants start moving billions through lending protocols instead of exchanges, that's capital flow that regulators can't easily track. That's not necessarily bad for Bitcoin price, but it's bad for regulatory visibility. Expect policy pressure within 6 to 12 months. Fourth, retail and smaller traders. This widens the wealth gap. Institutions now have a capital efficiency advantage that retail doesn't. Your Bitcoin holdings can't be collateralized at institutional rates. That's a game change for who captures upside. Here's what changes next. Over the next 30 days, watch for 3 signals. 1. Whether major holders actually use this strategy or if it stays theoretical. 2. What lending rates settle at. If rates are below 3%, adoption will be fast. If they're above 5%, it might not be competitive with selling. 3. Whether this drives a wave of protocol adoption and whether exchange volumes actually compress. The broader implication is about Bitcoin's path to maturity. This isn't the first time we've seen institutional infrastructure build around crypto. But it's one of the first times we've seen it solve a real institutional problem, capital efficiency, rather than just moving money between exchanges. So here's what you should monitor. If billions actually move into this strategy over the next quarter, expect Bitcoin volatility to contract in the near term. Lower. Selling pressure usually means tighter price action. But watch for a second wave, when regulators catch up and start requiring these platforms to register or report. That's when the real test begins. This is worth paying attention to because it's the kind of infrastructure shift that either accelerates institutional adoption or becomes a footnote. Right now, it's a door opening. What happens next depends on whether people actually walk through it. Follow along at Atlas Signal, IN for the real-time breakdown as this develops. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.